Good morning, everybody, and welcome to our IASB update session. I'm Anne Tarker. I'm an IASB board member. I'm joined today by Anne McGeechan and Anna Simpson, who are IASB technical staff. We're very, very pleased to be with you today and to be sharing an update about the activities of the IASB. We're sorry that we're not joining with you in person, and we're looking forward to next year, and hopefully we can all be together in person. This session is being recorded and it will be made available on the EAA website. We're very interested in your questions. Please post them into the chat box as we proceed, and we'll stop at various times to answer those questions. Anne McGeechan and myself have to leave 15 minutes before the end to go to the IASB board meeting and talk about primary financial statements. Anna Simpson will be joined by Laura Kennedy, IASB technical staff, and they will continue the presentation and answering your questions. So thank you very much. We will now begin our slide deck. Anna, if you can put it back to PowerPoint, please. It's gone off PowerPoint. Right, let me tell you what we'd like to cover today. So firstly, Anne McGeechan will talk to you about two major projects: the Targeted Standards Level Review of Disclosure and Management Commentary. After that, I'm going to talk to you about four other major projects. And we have lost the slides. They're coming back again. After that, I'm going to talk to you about two major projects, and then Anna will take the third session. She'll talk to you about the PIR of 10, 11 and 12 that's in progress. Also the upcoming PIR of IFRS 9. She'll also comment on the IASB's response to COVID, the agenda consultation that we've got open, and also the sustainability, the trustees consultation on sustainability reporting. So I'm handing over to Anne McGeechan. Thank you, Anne.
Thank you, Anne. Anna, I'm seeing on my screen a sort of a presenter view rather than an audience view. It's fine, I don't mind, just to let you know. Yes, we're going to start by looking at two major projects that the board is currently looking at. In fact, they are both just open for comment. The Targeted Standards Level Review of Disclosures was published a few months ago, and Management Commentary is, I believe, going to be published today. I hope I've got that right, and I hope we actually do manage to publish it today, but that is, I believe, the plan. If we start with the Targeted Standards Level Review of Disclosures, which is quite a mouthful as the title of a project, I have to admit. Anna, if you move on to the next slide. So disclosure is a topic that the board's been thinking about for a number of years. The board's identified a broad problem with disclosure in financial statements. Essentially, there's three parts to this problem. There's insufficient relevant information in financial statements, too much irrelevant information, and then ineffective communication of the information that is provided. And the board has already undertaken a number of projects to focus on specific ways it can help to solve that problem. And one example was making targeted improvements to part of IAS 1. Anna, if you could click again. So in this session, we're going to be concentrating on the Targeted Standards Level Review of Disclosures. And this really forms the board's central response to that overall disclosure problem that I described. So if we go on to the next slide. So this is where we are in the project. The ED was published in March 2021. It's out for comment until the middle of October 2021. I would encourage as many of you as possible to put in comment letters. We always appreciate receiving comment letters from academics. You give a very distinctive view you know, objective, not with vested interests. It's always good to hear from you. So please, if you have the time, send in your views. Okay, the next slide. So the board developed this project in response to feedback that we've received about the underlying causes of this disclosure problem. And so the first thing that we were consistently told that companies and auditors and others approach disclosures in financial statements like a checklist rather than approaching judgment. Second, almost all stakeholders that provided us with feedback tell us that the disclosure requirements in the IFRS standards are one contributor to that problem. For example, many think long lists of descriptive disclosure requirements make it difficult for companies to apply judgment. And effectively that enforces the checklist approach. If something is set out in a standard as being a requirement, it's very difficult for people to argue that they don't need to give it, even if the amount is immaterial. If we look at the next bit of feedback related to this, many stakeholders take the view that therefore the most effective thing that the board could do to help solve the disclosure problem is to take steps to improve the disclosure requirements in the standards. And then finally, however, it's really important that we realize the feedback was telling us throughout this work that this is a multifaceted problem. There's no one magic solution that's going to solve it. All stakeholders need to play their part if improvement is to be achieved. And the board's proposals, you know, form one part of dealing with it, but we can't do this on our own. And that's something that I'm going to come back to later. So how do the board's proposals respond? And the standards level review of disclosure project really contains two parts. The first is that in light of all the feedback that it's received, the board spent quite a bit of time thinking about the way in which it develops and drafts disclosure requirements and thinking about how can it improve that process. And the board's aim is to develop disclosure requirements that will help stakeholders to provide more useful information. And this slide sort of summarizes just a few of the key things that the board is proposing to do. The first relates to the importance of detailed and early stakeholder feedback. Stakeholder feedback is, of course, crucial to everything that we do at the board. But here the board wants to ensure that it gets the input that it needs for disclosures at the right time in the project. There may be in the past, there's been a tendency for disclosures to get left until the end of the project, that everybody's thinking really hard about recognition and measurement. And then, you know, you sort of sort out what you think the measurement and recognition requirements should be, and you suddenly think, oh yes, and we better have a few disclosures or maybe a lot of disclosures. We want to start thinking about disclosures early on, potentially even first. We need to get responses from users about exactly what information they do need. The slide also, you'll see, talks about balancing costs and benefits. And that's also something that's really critical to the board's work. But here, what's quite interesting is that, you know, we often think that the balance is a question of, you know, the users want information and the preparers say it's going to cost them a lot to prepare the information. And that's the cost balance that people think we're talking about. But actually, that's not proved to be true. When we talk to people in this project, we find that users They want financial statements to focus concisely on information that's really important. And at the same time, preparers also want to focus on what matters and don't want to spend resources preparing pages and pages of disclosure if the disclosure doesn't actually convey useful information. And so in some sense, they're both wanting the same thing. And that's what the board is going to try to be responsive to. The second proposal is about using detailed and specific disclosure objectives in the standards. Now, the point about these disclosure objectives is that they explain not just what information users want, but why they want it, and importantly, what they're looking to do with it. So, for example, what analysis are they looking to perform? And the purpose of setting up objectives like this is to help companies understand the point of the different disclosures. And that should help them make more effective judgments about what to disclose and indeed what not to disclose. And then finally, I want to mention a point about language. The board's proposing to typically focus the compliance requirements, so where we say in a standard an entity shall disclose, using the word shall, to focus that on disclosure objectives. So in order to achieve or assess compliance with the disclosure objectives, stakeholders will have to ask themselves whether the information disclosed is sufficient to satisfy the investor need that's described. And we hope that that will result in stakeholders applying judgment in order to do that assessment and not just relying on a sort of checklist, a list of disclosures that's required. Okay, so on the next slide, everything that I've talked about so far describes a proposed new approach to developing and drafting disclosure requirements in the standards. And we refer to that as guidance for the board. So part of this project is developing guidance for the board so the board can, in future standards, develop better disclosure requirements. And this represents a potentially significant change to the way the board does things, and therefore it needs to be tested thoroughly. And so in the second part of the project, the board selected 2 standards to do that testing. And in selecting the standards, the board deliberately chose standards that contain many of the issues that stakeholders describe about disclosure requirements. So the 2 standards that we chose are IAS 19 on pensions and IFRS 15 on fair value measurement. Having selected those 2 standards, the board applied the approach I've just described and went through the disclosures in the standards and thought, well, if we were applying this new approach, what disclosure objectives would we come up with? In doing that, the board spent time talking to stakeholders, talking to users about their detailed information needs. And the board used that feedback to develop detailed and specific disclosure objectives and to come up with new disclosure sections for both IAS 19 and IFRS 13. Having done that, the board put everything together into an exposure draft and put the exposure draft out for comment. Before I talk a bit more about the 2 test standards that we've looked at and the exposure draft, I just want to highlight a final important point about the guidance for the board. The board sees the guidance as part of a sort of iterative process and expects to keep learning and making improvements as we go. So we have been working on IAS 19 and IFRS 13, and we learned some lessons, and as a result of that, we improved the guidance for the board guidance. And we would expect to go through that same process when we get the feedback on the exposure draft. So Have we lost the slides? Sorry, Anna, this is hard for you.
We were trying, Anna was trying a fix. That fix didn't work. So we'll go back to the stream. Oh, there we go.
Is
That's
this
better.
okay?
It did work.
It did
So we
work.
can
Okay,
just
yes,
see the slides.
Yeah.
Apologies
Thank you.
for the.
That's
Thank
right.
you. Thank you, Paul.
Okay, so if we could move on to the next slide, Anna. So looking at the proposed amendments to IAS 19, I'm just going to keep this high level and focus on the most significant feedback we heard and how the board proposals respond to that. So in working closely with the stakeholders on IAS 19, the key messages that came out of that work were one that users really, what they're really interested in is the risk arising from defined benefit plans. And the single most important thing to users about the defined benefit plans is often the cash flow effects. So rather than details about the liability and the plan assets, actually what are going to be the effects on the cash flows in the future. Sorry, Anna, I'm seeing the slide before rather than the IAS 19 slide. Thank you. Another problem we hear about the pension disclosures is that the communication just is very ineffective, because users, acknowledge that they get pages and pages of detailed pension disclosures, but they can't really piece the information that they're getting together, and they don't really understand how that relates to the primary financial statements. And equally, at the same time, companies tell us that those detailed pages of information can be onerous to prepare. So, there's clearly something not quite working about the disclosures in IAS 19. The board's proposals respond directly to the feedback. So the proposed detailed disclosure objectives focus on risk exposures and on the cash flow effects, and on the need to communicate information in a way that enables users to navigate the information they're receiving and understand it. Some people we've heard describe this as an executive summary, that's what needs to be given, something that gives users, what they need in a concise form that they can understand. If we move on to the next slide. So moving on to IFRS 13, we had quite different messages actually about the disclosures in IFRS 13. And here it's been really mostly about materiality. Users say they get, again, pages of information, but it's about immaterial fair value measurements. And they don't get very much information about the fair value measurements that they regard as significant. And again, at the same time, companies tell us that the pages of information that they prepare, that's quite an onerous burden to prepare. And they say that users rarely ask any questions about them. So they feel that they're preparing all this information and maybe it's not very helpful or not being used. So it's the messages we've heard, it's not so much that the technical content of the fair value measurement disclosures is the wrong content. It's more that the information isn't given about the most useful population of items. So in testing the guidance for the board here, you could say that one measure of success would be a set of disclosure requirements that helps companies to make meaningful materiality judgments. So it helps them to focus their information on the fair value measurements that users are actually interested in. And by explaining user needs in detail and by focusing the requirements on objectives that have to be met rather than a checklist of information, the board's proposals are intended to do that thing about focusing people's minds on, what is material, what do users really want to know about fair value measurements. So, moving on, what stakeholder input is the board looking for? So, I think it's very important to remember that the exposure draft includes these two things. It includes the proposed guidance for the board and the proposed amendments to IS 19 and IFRS 13. And the board is absolutely looking for feedback on both those things. And I just want to go back to a comment I made about the start about how what the board is doing is just one step in a bigger picture. So the exposure draft is more about the proposed amendments to the two individual standards. It represents an opportunity to move towards a step change in the way that the board thinks about and approaches disclosures. But also that's not something that the board can do alone. The board needs to understand the effect its proposals would have. So, for example, are the proposed detailed disclosure objectives in IS 19 and IFRS 13 specific enough to enable companies to make meaningful judgments, and also to enable auditors and regulators to review those judgments? So no amendments that the board makes to standards will provide a miracle solution. We need to understand what everybody will make of these proposals. And again, that's really where you can play a part in telling us what information you have from your research that would shed light on this. Are detailed disclosure objectives a good way forward compared to prescriptive requirements? It's something we'd be very interested in. And then finally, on disclosures, as well as asking you to comment on the ED, I want to publicize that there's a call for papers on disclosures from Accounting in Europe and the British Accounting Review. And that's being organized, together with us. And we are inviting submissions of papers on diverse aspects of disclosure, including areas of specific interest to the board, and drawing on diverse research methods and approaches. More details are available using the link on the slide. So please do go and look at that call for papers. Okay, and then before moving on, do we have any questions on the disclosure?
No, Anne, we don't have any questions. So I think in the interest of time, we could just move on to management commentary. Thank you.
So the second project I want to talk about is our project on management commentary. Again, this is very timely because I think it's going to be published today. What is the board doing in this project? So the ISB issued a practice statement on management commentary in 2010. But since then, there have been changing information needs and many developments in narrative reporting. But the board's research indicates that management commentary maybe is not keeping up with the changing information needs or the developments. And in particular, we've identified that the management commentary is failing to focus on matters important to the entity's prospects by failing to give material information or obscuring material information with immaterial information, contains too much generic information, that focuses on short-term matters, and doesn't include sufficient discussion of things about systemic risks or strategic challenges. The matters that are of increasing importance to investors and creditors, information about intangible resources and relationships, and ESG matters aren't being covered in the best way that they could. So if we move on to the next slide, what is the IASB aiming to achieve? We want to develop comprehensive requirements that focus management on investor and creditor needs and give guidance to help management identify that information and present it clearly. So there's a lot of common themes between this project and the disclosure project. It's all about helping management to identify what information users really want. The board wants to develop requirements and guidance that give sufficient flexibility for management commentary to focus on the matters that are fundamental, but also sufficient discipline to allow external assurance of management commentary and to enable local lawmakers and regulators to mandate the practice statement and check that it is complying. So we envisage that the practice statement could be used in conjunction with local laws and regulation, and we hope that it will, address gaps in the reporting practices. So on to the next slide. So what are we actually proposing? This slide gives a picture of the structure of the exposure draft, and what the exposure draft does is it sets up, very similar to the disclosure project, comprehensive objective-based. It's a comprehensive objective-based framework. So it sets an objective for management commentary. It then identifies the areas of content that need to be discussed in management commentary and gives disclosure objectives for each area of content. And then in addition to that, it gives guidance on how to select and present information to satisfy those disclosure objectives that it set up. And we'll look quickly at each area in turn. So firstly, looking at the objectives of management commentary. There, the objective of management commentary is to give information that enhances understanding of the company's financial statements and that provides insight into the company's ability to create value and generate cash flows. So we're looking both at what has happened and what might happen in the future. And because we're looking at what might happen in the future, management commentary is going to include more discussion and analysis and more forward-looking information and non-financial information than you get in the financial statements. The objective of management commentary is linked to the objective of financial reporting in the conceptual framework through the definition of material information. And so that identifies the need to focus on the primary users, which are investors and creditors, and to provide information for their assessments of future cash flows and stewardship. And those assessments are the end goal of the information in management commentary. The aspect of understanding what's in, enhancing what's in the financial statements is well understood, but this aspect of providing insight into the ability to create value and generate future cash flows is what we're going to talk about a bit more. So the disclosure objectives, the way that this works, for each area of content, you have a headline objective, and then you have assessment objectives, which are based on the information needs of investors and creditors. And so that sets out the assessments that they are going to do based on the information that's provided. And then there's specific objectives that lead to the provision of information so that investors and creditors can make that assessment. And so the way that this works is that management identifies the information needed to meet the specific objectives at the bottom of that sort of hierarchy. It then evaluates whether that information provides a sufficient basis for the assessments. And if it doesn't, then management needs to identify additional information. And then it evaluates whether all the information is enough to meet the headline objectives. And we think structuring it this way will help preparers and regulators and auditors in deciding whether they have met the requirements. And as I say, it's very consistent with what we're doing in the disclosure project. So having a quick look at an example. So one of the content areas is the business model, and this is how these objectives work. The headline objective is to give information about how the business model creates value and generates cash flows. And the assessment objective is that users want to know how effective the business model is, how scalable and resilient it is. So how can it adapt to shocks or changes in circumstances? And then the sort of information that you would give to allow users to make that assessment is you give information about the range of the company's activities, the cycle by which it creates value, environmental and social impacts, and progress in managing the business model. And just touching on that last point there, metrics, we'll come on to talk about them. For metrics for measuring how the company is achieving its goals are an important part of the information that the practice statements proposes should be given. Okay, moving on. So this slide tells you what the content areas are. There's the business model, there's strategy, resources and relationships, risks, and external environment. And then all of these combine to give a better understanding of financial performance and financial position. And the objectives all obviously interact with each other and are linked. And in the exposure draft, there's a diagram that sort of shows how the board see how they all fit together. I'm going to move on quickly because I realize I'm running out of time and have probably run out of time. So that sort of identifies the types of information, that the content that the board thinks is important. The ED also contains guidance on how to focus on getting the right information for those content areas. So it gives guidance on making materiality judgments, and a really important part of that is the guidance on key matters in order to focus information on, to allow preparers to see what information they should be giving on focus matters. The ED identifies these key matters that are likely to cover most of the material information. It also gives indications of when information might be material and guidance on aggregation and things. But sort of this identification of key matters is a really fundamental part of the ED. The next slide. As I mentioned earlier, metrics, so understanding how the management monitors its own progress and monitors how it's achieving what it wants to achieve. It is important information for users, and so the ED identifies metrics for each content area, which is how management measures their progress, and information about those metrics is required to be given. And that way, users get entity-specific information about the metrics that the company actually uses. And moving on, the ED also talks about what makes information useful, and this is based on the conceptual framework, but the wording is is simplified because the people who are preparing the management commentary, it's a wider group of people who are involved rather than just accountants. And so we've tried to use more plain English in describing the qualities of useful information. Relevance from the conceptual framework is captured in the requirement to produce material information, and completeness, balance, and accuracy are sort of plain English ways of talking about faithful representation. And then we have some enhancing characteristics as well. So there's more explanation about how the qualitative characteristics that are in the conceptual framework apply to management commentary. And there's also finally a detailed appendix on information that is clearly of increasing importance to users on long-term prospects, intangibles, and ESG matters. And so the board has highlighted specific information that would be relevant when you're thinking about giving information about these things. And then the last slide sets out the timeline. So as I say, I believe the ED is going to be published today. The comment period is open until the 23rd of November 2021, and then the board will consider the feedback it gets. So again, I'd really encourage you to read the exposure draft and respond to the board. It's an area clearly of increasing importance, and the board would be interested in your views. And if there are questions now.
No, I don't have any questions for you, Anne. But
Wow.
I would encourage people to have a look at these documents and comment on them. They're two major projects for us, as Anne has said. And we chose to talk to you about these two projects today because we believe this is an area where researchers and academic research can contribute. So we look forward to hearing from you if you have relevant work. Thanks, Anne.
Thank you.
So I'll take over now and talk to you about some other projects. Next slide, please, Anna. We have a current project on primary financial statements. Some of you were with us a year ago when we were talking to you about this one. So the consultation period was last year, and we received an enormous amount of feedback because this is an important project with significant initiatives. We're currently in the deliberation phase of this. You'll remember that this is about improving communication in the financial statements. So this project continues on from the two projects that Anne has been talking to you about. It's a focusing on the profit and loss statement. Next slide, please, Anna. Some of the key proposals in the document, for example, defined subtotals in the statement of profit and loss. We've received strong feedback. There are a lot of people that really support this idea. This will bring more structure to the profit and loss statement. It will make it better for investors to compare entities' performance. A second thing in the proposals is strengthening requirements for disaggregation. That has also received a lot of support and a lot of feedback on how we can enhance the suggestions that we've made so far. This point is about providing information useful for decision making, and also with a focus on the relevant information and not obscuring material information. So you can see that this is part of the better communication projects, and two of which Anne's referring to. The third area is non-GAAP measures. So these are defined in the document as management performance measures, and we received a great deal of feedback on those. Next slide, please, Anna. There are IFRS specified subtotals and totals, and after this project, there will be more of them. So in the middle there on the left, you can see IFRS specified profit and loss, operating profit, and so forth. In our proposals, we define MPMs, management performance measures, as those totals that have been modified So an adjusted profit and loss, adjusted operating profit, and so forth. We received a lot of feedback and indeed a lot of support for taking MPMs and putting them in a note in the financial statements. So they're in one place. So there's more transparency, there's more discipline, they're audited. A lot of support for that. Indeed, there are many commentators who asked us to consider adding more things to our MPM list. So for example, the things on the right-hand side in this slide, people have asked for us to consider adding those, and we are in process of considering. I'm not saying that we're going to do it. I'm just saying the board is looking at it now. Next slide, please, Anna. So that was all for primary financial statements. I realize that was very brief. Please go to our beautiful new website. You can find lots of information. And we are exploring in detail the feedback, and we're looking, and as we speak, the board papers are coming out and we're addressing these. So if this is an area of interest for you and your research, please watch this space, because it's lots of things are happening. Second project to talk about, goodwill and impairment. Again, many of you know that there's been a major consultation via the discussion paper that was released last year, a consultation period, again, an enormous amount of feedback, and the board is now considering. So staff and board together having a look at the extensive feedback that we've received. Remembering, of course, the objective for this project, that it's about improving the information companies provide in relation to their acquisitions. There was a second consideration, which was whether anything could be done about the impairment test. So next slide, please, Anna. So you can see the objectives there, more useful information, but also reducing cost in terms of the impairment test. One of the things we have found out, considering the last 10 years with the impairment only model, is that it's quite complicated to do the impairment test. It's not a simple activity. And consequently, for some people, they consider that the benefits don't exceed the costs. Judgment is needed in many areas of financial reporting. So doing impairment testing is not the only area where judgment is needed, but we do recognise there are lots of judgments within the impairment test. So in this slide, we're illustrating for you the package that we put into the DP. So we asked people to think about all these things and to consider in their views which things the board should proceed with and those that they didn't support. But as you can see, looking at the slide, these things interact. So people's views on one issue are often affected by their views on another, or indeed their views are affected about what the board decides on another issue. So maybe have next slide, please, Anna. So for example, one of the detailed and important proposals within the DP is about improving the disclosures on acquisitions. So we've heard that investors don't have enough information on which to evaluate companies' acquisitions. So this is about holding management to account for the capital that they've invested in the acquisitions. So a stewardship function here. And the argument is that investors don't have enough information to do that adequately. So there are several proposals in the DP about additional information. So how did people respond? Well, there's very mixed feedback on this. The disclosures are supported by many users. However, they are not supported by many preparers who say that there are issues in relation to cost, there are issues in relation to commercial sensitivity of the disclosures, but also the fact that many investments, many acquisitions are integrated into the operations. They're not kept separate, so it's difficult to monitor that performance. Now, we're aware of that type of feedback, and we do comment on how we think that would be accommodated in the DP. Next slide, please. Another big area of work is about simplifying the impairment test. So in response to the criticisms of the impairment test, the assessment of goodwill, subsequent goodwill accounting and impairment tests as too little too late, we've looked at can we improve the impairment test? That's a big area of discussion. Other aspects of the discussion about whether the test could be simplified and therefore take some cost out of the system. So one of the things we looked at was whether the board could give some relief from an annual quantitative impairment test. And other things the board looked at were things like simplifying the way value in use estimates are calculated. Other things are using a post-tax discount rate and post-tax cash flows. So there's discussion on all those points. One of the things that's emerged from the feedback is that for some people, their view on an annual quantitative impairment test is linked to their view on amortization. So were the board to bring back amortization, they'd have a different view on the annual impairment test compared to if the board does not bring back amortization and stays with the impairment only model. So if this is an interest area for you, there's an enormous amount of research. Anna has recently completed a detailed literature review, building on other literature reviews that exist that we have explored. Indeed, in EAA seminars, we've looked at the goodwill literature with Anna and with other members of EAA. So there's a lot of material there. If you are interested, you can access that literature review from our webpage and also from the board pages. Moving now to the next slide, please, Anna. The third project I wanted to mention is business combinations under control. Again, I think this is an important project because it's pervasive and it will affect many entities across jurisdictions. We're open for consultation now on this project, continuing to the middle of this year, after which point we'll take the feedback and so forth. This project is about filling a gap in IFRS standards because IFRS 3 has an exemption for business combinations under common control. IFRS 3 doesn't apply. And what we know is that there's great diversity in practice in terms of accounting for business combinations under common control, with some people making use of the acquisition method as per IFRS 3 and other people using some form of a book value method. Next slide, please. This slide tells us about the scope of this project, as I say, to fill a gap in standards. The transactions that would be within scope are all transfers of a business under common control. So common control, illustrated in the little diagram, entity P has control of A and B. And the company that's being transferred is company C, going from under B over to A. So the accounting that we're looking at is for the receiving company, that's company A, and it's typically in consolidated financial statements. Next slide, please. As we proceeded with this project, our guiding light, if you will, has been arriving at useful information. So what would be useful information for the primary users of the receiving company's financial statements? So that's company A, the receiving company. And so we thought about the users of information. Who are they? And what information do they require in this special situation of being under common control? So we're looking at this through a cost-benefit lens. If we think about who are the shareholders of company A, there could be non-controlling shareholders. There could be potential shareholders in the IPO situation, and there are also lenders and creditors to entity A. Now, all these primary users could have different information needs, and that's something that we've been exploring as we've looked at this project and deciding on the method. So it becomes a matter of deciding where to draw the line, because if we have external shareholders like non-controlling shareholders, they need the same sort of information as people need for an IFRS 3 business combination. However, if it's wholly owned and there are not these external non-controlling shareholders, the information needs are different and for them, possibly a book value method's appropriate. So this becomes a question of where to draw the line. Next slide, please. Here's our diagram of how we work through that process of deciding where to draw the line. So thinking about information needs of investors, for our first box, we say, are there non-controlling shareholders? And if there are, we go to the acquisition method. Our second question is about the receiving company's shares being traded in a public market. Again, acquisition method. However, because we're thinking about costs and benefits, we also ask some other questions, and they're related to related parties, or whether there could be an optional exemption where the non-controlling shareholders elect that a book value method would be suitable. So that's what we're working through at the moment, open for consultation, very interested in feedback, and if people have papers, please get in touch with us, and we're very interested in the research in this area. Next slide, please. Fourth project, rate-regulated activities. It doesn't affect everyone as broadly as the other three projects, but still a very important project for entities in Europe and entities elsewhere. So this is about, for example, utilities you may know that supply you with electricity, or utilities that supply you with water. We're talking about a situation where there's an entity that supplies the goods and services to a customer, but there is also a third party involved, and that third party is the regulator. So we're talking about entities that have a regulatory agreement with a regulator. So we have published our exposure draft. Consultation is open at the moment. The objective of the project is provide useful information for investors, as so many of our projects. So this is about providing useful information, something we're describing as regulatory income, expenses, assets, and liabilities. Because of the environment in which these entities conduct their business, there's additional information that investors need, additional to what is available through IFRS financial statements. So in these proposals, there is required recognition of regulatory assets, liabilities, income, and expense, and we've defined them and explained what we mean by them. The idea of the proposals is to reflect the compensation for the goods and services supplied in the statement of financial performance in the period in which the goods and services are supplied. So it's an accrual accounting idea. It's accounting to recognize compensation in the same period as the goods and services are supplied. Very much an accrual accounting concept. Next slide, please. So we're doing this project because we're thinking about investors and useful information for them. What happens in this setting is there becomes a timing difference, what's referred to as a timing difference, because the regulator allows the compensation in a subsequent period, not in the period when the goods and services are supplied. So it creates a timing difference. So we have a model here within this ED that will accommodate those timing differences that arise through the regulatory agreement. Next slide, please. All I was trying to show on this slide is how things might look under IFRS accounting presently, and what we might do, or what we do in the model. So without regulatory, the accounting that we're proposing in this model, we would not see the timing of the revenue to reflect when the goods and services are provided. So our model makes use of the regulatory asset and regulatory liability, and then working with regulatory income and expense, so that the revenue of the period does reflect the goods and services that have been supplied. Very high level and very brief, but if this is of interest, please have a look on our website. We've got many, many materials available, both the detail in the ED, but also the accompanying documents that can explain how it works, the snapshot and those things. So I'm going to pause there. I have a question on MPMs. Anne, do you want to give me the question?
Yes, well, there is a question. I wonder, Anna, it's from Anna Marquez. Anna, would you just like to unmute and ask it yourself?
Sure. So, like you said, Anne, there's been some pressure, and I've seen it in conferences and discussions to include several subtotals, not just the other ones, right? Some people suggest that, oh, we need more subtotals. We should define more precisely what those measures are. And I understand that rationale, but on the other side, I'm also a bit afraid that if there's too much standardization, then we go, well, to the other end of the story, which is then the fact that the non-GAAP measures are built for each firm at each situation to take into consideration, I don't know, whether there's restructuring, a flood or a fire or something unusual is lost. So what I'm saying is it being considered that if there's too much standardization of these subtotals, then the unique information that used to come with these measures can be lost? Okay, so that is my first question. And I have another
we'll take them one at a time. Let's do that one first. Yes, so with the idea of the operating profit, the default category of operating profit, that will mean everyone will produce a subtotal that's operating profit, which doesn't exist now. And the operating profits that do exist now are not comparable. They're just whatever people decided. So it'll be standardized in that way, in that it's a default category. There's very specific steps how you get to that. So the operating profits will be comparable across all the entities, which should be beneficial for investors. And now for some entities, they'll stop there. They won't do a non-GAAP. They won't do an MPM. They'll just go with operating profit. But Anna, to your point, I think that many entities will still do a non-GAAP or an MPM, because they'll go adjusted operating profit if they want to highlight something. And many of you know from your work and other research, I mean, a lot of it's about highlighting and saying, well, here's an operating profit, but I'd like to highlight, and I'm going to take out this impairment expense as a non-recurring item, and I'm going to take out this particular piece of revenue. But of course, that's quite rare, but you know, theoretically, I'm going to take out this piece of revenue because it's a one-off, it's not going to occur again. So I think there is some standardization, but I don't think non-GAAP's going away. I don't think it will go away. Yeah, so, because of how individual it is. That's what you're saying. It's so individual, yeah, exactly. The adjusting items. I don't think people will pass up on that. I think it'll continue. So second question, please.
Second question. So given that there's the project on the management commentary, right? And I saw that the changes that Anne was discussing on that project. Has at some point been considered the fact that the managers may wish to provide this management performance measures or the non-GAAP in the management commentary, right? Because there's been a lot of discussion on, oh, if we give too much emphasis to these measures, again, the bias from the investors may occur, right? So, and so that's my question, if it has been taken into consideration or because
absolutely.
Look at the press releases, as you know, but it may very well be that then the firms move into the management commentary.
Yes, absolutely. There's a lot of discussion on this because we know in some jurisdictions that is where the non-GAAP or the MPMs, but the non-GAAP is, the APMs or non-GAAP is in management commentary. It's in press releases, it's in management commentary, it's not within financial statements. So there has been a lot of discussion on this, but the feedback, there is a lot of support for putting the MPMs, the adjusted operating profits and so forth, in a note in the financial statements. And that support's coming from the investors because they'll now know where to find it. They won't have to go all over the place. They know where to find it and they will be reconciled. And we know how important the reconciliations are. And there will be then, and because it's within the notes, it'll be audited as well in the sense of whatever they're choosing to present there, the auditors will be looking at it. Now, we know that auditors are looking at it anyway when it's in management commentary. So there has been a lot of discussion and there is support for us doing that. there are lots of people that would prefer that it just stays in management commentary, but we don't have a financial statement we don't have a financial accounting standard for management commentary. So a management commentary is a practice statement, and that puts it into a very different domain. So we got the feedback and we have got a lot of support. So we're going to keep going. If we hadn't got all that measure of support for putting it into the notes, then it'd be a different conversation. But certainly we've talked about the things you just raised, and there's been a lot of support. So we're still talking and going on, but we're definitely going in that direction towards a note. Thank you for your questions, Anna, and it's lovely to see you. And I think I have to stop because, yes, it's time for Anna Simpson to chat with you about some more things. So thanks, everyone. I'm going to hand over to Anna, and I'll say goodbye because I have to duck out shortly. Thank you.
Thank you, Anne, and good morning, everyone. I'm going to provide you with some further updates. I will talk briefly about the post-implementation reviews that are currently undergoing, and these are the PARs on IFRS 10, 11, and 12. I will also talk about the post-implementation review of IFRS 9, the classification and measurement section of financial instruments. And then we'll speak a little bit about the board's response to the COVID-19 crisis. And finally, just briefly on the agenda consultation and sustainability consultation. So before I talk about the undergoing post-implementation reviews, just shortly on what post-implementation reviews are. The board carries out a post-implementation review of every new standard around 2 or 3 years after companies have been applying the standard. And the purpose of the post-implementation review is to assess the effects of the standards for investors, companies, and auditors. And these post-implementation reviews are part of the due process, and they follow the requirements in the due process handbook. So currently, the board is carrying out a post-implementation review of IFRS 10 consolidated financial statements, IFRS 11 joint arrangements, and IFRS 12 disclosure of interest in other entities. These standards have been effective for annual periods starting on January the 1st, 2013. So IFRS 10 sets out the requirements for the preparation of consolidated statements. IFRS 11 addresses how to account for interest in joint arrangements, and IFRS 12 sets out the requirements for information to be disclosed in the notes of the financial statements about interests in other companies. And this timeline here on this slide shows the major stages of the post-implementation review in general, but also specifically to the post-implementation review of these 3 standards. So the first phase, which was started Q2 of 2019 and ended last year, the board has had a discussion with a broad range of stakeholders and has reviewed all types of evidence, including academic research evidence. And in step 2, which was last year, the board considered feedback from these activities and decided what matters to include in the request for information. And the request for information was published in December in 2020, and its consultation period ended on 10th of May 2021. So what is happening now is into the second half of 2021, the board will use the feedback that has been received from the request for information, and it will determine whether any further action is required. So it will depend on this feedback whether the board will decide that no further action is required, or whether it could decide to add a standard setting project to its agenda. And it could even consider one or more matters further to be added to the research program. And for those of you who have an interest in this area or are working, I would like to remind you, or if you haven't had the chance to, if you didn't know about this workshop, we held the workshop together with EAA sometime in March. This was to provide an overview and get feedback on the post-implementation review of these 3 standards. And you can find the recording of the workshop, also any materials that were used. The link is provided here. And at the time, we called for academic research to be sent to us, and my email is included in the yellow box. It is still, if you do have such research, this will still be relevant for when the board is considering the feedback from the request for information. So by all means, please send it to us. And then the other post-implementation review that is currently underway is IFRS 9 financial instruments, the classification and measurement section. And this, again, there is a timeline here showing the stages of this post-implementation review. In October last year, the board decided to start the post-implementation review. With regard to the other 2 sections of the financial instrument standards, and I'm going to show a brief overview of the standard on the next slide. The board decided in October that it did not have enough information to start the PAR about the hedge accounting requirements and the impairment part of IFRS 9. And these areas will be revisited at some point later this year. So in December, the board discussed the preliminary project, and what has been happening in the first half of this year. Staff have been performing outreach activities to gather feedback on the application of the classification measurement requirements. And what the staff has been trying to establish is whether these requirements are working as intended, whether there are any significant unexpected effects, and whether the requirements are capable of being applied consistently. And in the second part of this year, after staff conclude the outreach activities, the ISB will discuss feedback from the outreach and decide what matters to examine in the request for information, which will be published later. And now, because I mentioned the other 2 sections, I just want to put the classification and measurement section of IFRS 9 and the other sections in to a bit of context. The standard has been effective since January 1st, 2008. In 2014, the board published the completed version of IFRS 9, which brought together the classification and measurement, impairment and hedge accounting phases of the board's project, and thereby replaced IAS 39. And IFRS 9 is built on a single logical classification and measurement approach for financial assets. And this approach reflects the business model in which the assets are managed and their cash flow characteristics. And built upon this is a forward-looking expected credit loss model that will result in more timely recognition of loan losses, and is a single model that is applicable to all financial instruments subject to impairment accounting. The standard also includes an improved hedge accounting model that better links the economics of risk management with its accounting treatment. And currently the board has an ongoing project on dynamic risk management, and entities can choose to continue using IAS 39 hedge accounting requirements while this project is still ongoing. So again, this is a reminder of an academic an initiative that we held. We launched that was aimed at academics. In January, we conducted a webinar and the purpose of this webinar was to provide some more information on the standard, but also to stimulate academic research. So in this webinar, we discussed some questions that could lead to potential research, which will be useful for the upcoming post-implementation review. Again, you can access the recordings of this webinar through our YouTube channel. This is a link on our website, and also the materials for these webinars. At the time, we again asked for you to send us relevant research, but this is also, so you can do so directly by emailing me, but also this webinar was part of a bigger initiative, again, in anticipation to stimulate academic research and to inform academics on what questions will be of interest to the board. And this is part of a bigger initiatives which you've probably heard about in 2022. The ISB, the FASB, and the Accounting Review are holding a joint conference, and this is the at the bottom of this gray window. You can see the a link to the website for the conference, which is Accounting for an Ever-Changing World. And this conference has a wider topic than IFRS 9 because it encourages submissions of academic research on the three major standards that the FASB and ISB are going to be reviewing, but one of them is financial instruments. So just flagging this for those of you who are planning to submit research there. So just briefly on what the board's response has been to the COVID-19 crisis. First of all, the board has been hearing feedback from the various stakeholders, and the indication of the general feedback is that even though there are reporting challenges that have arisen, the IFRS standards have been working well in practice overall. For example, stakeholders, including some investors, have said that the expected credit loss model in IFRS 9 provides useful. Though some questions have
Anna, I think we've lost you.
the
Oh, Anna, can you hear us?
Can you hear me?
Yeah, sorry, I think you cut out for about 30 seconds or so there.
I will share the screen again. I'm not sure. Can you see my screen?
Yeah, that's back up now. It's not on presentation view yet, but we can see it.
Thank you, Laura. My technological skills have not been perfect today. Can you see the slides on presentation mode?
We can, yeah.
Thank you. So I was, I'm not sure at what point I cut out, but I was mentioning that a limited number of IFRS jurisdictions have introduced carve-outs of exceptions from IFRS requirements, for example, ignoring the effects of COVID-19 while making estimates, but these carve-outs or exemptions are very limited in nature and temporary, so the board is monitoring these developments. And financial reporting challenges have, of course, arisen in relation to the crisis, and mainly in relation to estimates. So the crisis has highlighted the need and the importance for reasonable and supportable information to be provided at the reporting date, and which is developed through a robust process, and obviously the importance of relevant and transparent disclosures. And the standard setting process, basically the board has had to do where necessary some urgent action, and I'm going to talk about and this has been mainly through publishing educational material to clarify the application of some standards, but also in the context of COVID-19 related rent concessions, the board has had to publish an amendment to a standard. So I will skip through this slide and just briefly talk about this example. The board has been informed that the evaluation of whether rent concessions are lease modifications and the related accounting for it, if they are lease modifications, can be practically difficult for leases, because there was a large volume of rent concessions being granted during the pandemic. So the board issued an amendment to IFRS 16 in May last year to provide optional practical relief for lessees, while still enabling them to provide useful information about their leases. And the board has also, in terms of supporting stakeholders, has had to advance, for example, some time-sensitive projects, or defer the effective date of consultation documents, and the effective date of standard, or increase the comment period for consultation documents. So all these actions have been taken in support of stakeholders during the COVID-19 crisis. And before I move on to the slide on agenda consultation, I wanted to again highlight that all this information is available on the website. And as Anne mentioned, we have had a major reorganization of the website, and hopefully now it's much easier to find information if you go to ifrs.com/academics. So on agenda consultation, we had yesterday in the very beginning of the EAA Congress a session on agenda consultation, and its recording is going to be uploaded on the website of the EAA and also of the IFRS Foundation. So I'm not going to spend much time on this here. But this just gives you the context of the agenda consultation that is currently out for comment. So the board undertakes such a public consultation for its agenda and its work plan every 5 years. And this is the third time that the board is undertaking such feedback. And the objective of the agenda consultation is to seek feedback on the strategic direction and balance of the board's activities, the criteria for assessing the priority of financial reporting issues, and also receive feedback on any new financial reporting issues that could be added to the work plan. And even though the focus so far has been mostly on the third part, the other two areas that I just mentioned are equally important to get feedback on. And the responses to this consultation will shape the thinking of the board when finalizing its work agenda for the next 5 years. And in doing this, the board will use not only the feedback from the consultation, but also rely on its own expertise and experience. And this timeline shows how this agenda consultation will, the process of the consultation will unfold. The request for information for public comment was published in March this year, and the comment period will end in July. And then the board will start deliberations in the last quarter of 2021 with the expectation to publish a feedback statement in the second quarter of next year. And this would, again, this consultation would help the board to finalize its agenda for the period 2022-2026. The new ISB chair, Andreas Barkov, is joining the ISB in July, as of July this year. So this will give him a chance to be involved in setting the agenda of the board for the next 5 years. And finally, just looking at the time, I want to briefly talk about the trustees' sustainability consultation. And firstly, how the two consultations are linked and how they're different. The agenda consultation is a consultation of the International Accounting Standards Board, whereas this trustees' sustainability consultation is part of the strategic review that is conducted by the IFRS Foundation trustees. And the aim here is to increase, expand potentially the role of the IFRS Foundation into sustainability matters, whereas the agenda consultation that is conducted by the board is to seek feedback on the areas that I discussed, but on financial reporting issues to be added to the work plan that is within the current scope of the board's activities. So the IFRS Foundation Trustees Sustainability Consultation was published in September of last year with a 3-month comment period, and it sought feedback on the demand for global sustainability reporting, whether questions such as whether the foundation should play a role in them, and if so, what would be the conditions that should be met. For example, whether there is support from authorities and regulators, how it will work with existing initiatives and so on. So the trustees performed a very extensive outreach across 33 jurisdictions, and they spoke to organized a large number of workshops which attracted more than 3,000 participants. At the end of the consultation period, there were 576 comment letters that were received. And what emerged from these from the summary, the feedback of the consultation was that there was broad support for global sustainability standards and strong recognition that urgent steps need to be taken. And there was also broad support for the IFRS Foundation to play a role. The process of this sustainability strategic review by the IFRS Foundation trustees have been moving very quickly. There was in March, the trustees published a feedback. They decided on the strategic direction and on set up a working group. In April this year, they published the feedback statement based on a summary of the consultation, and they also published proposed changes to the constitution, which would allow for setting up of a new sustainability standards board. And also they announced the plan to form a multi-stakeholder consultative committee, and there is now an exposure draft for the public to comment on the proposed changes to the constitution, which the comment period ends in July, and then in the next 3 months to October, the trustees will be summarizing this feedback, and there will be a final determination of the direction of development by November at the United Nations Climate Change Conference. Again, there is, we held a workshop with the EAA in November. Obviously, given the fast development of this strategy review, some of the information in it may not be longer up to date, but if you're interested in what this initial consultation entailed, you can check it out. And this is again on EAA and also on the IFRS Foundation's website. So I'm sorry, we haven't, we didn't have, we don't have much time for questions at the end, but Laura, do we,
Hi, Anna.
do we have any questions?
We don't have any new questions on the chat at the moment for this section. I know.
Oh, okay. I was
short,
just,
but
right. Well, if you, again, what I want to iterate from what they said in the various sections, if you have any academic research that you want to bring to the attention of the board in relation to any of the projects that we discussed, please use my email to send it, because we write literature review that are presented to the board, and the last one was Goodwill Literature Review, which included all papers that had been sent to us, and also based on recent literature reviews that have been published. So I think this would be a very direct route to make your research known to the board. So please send me relevant stuff. And thank you very much for your attention, and I wish you all the best. Bye-bye.
Thank you.